Benvenido. Okay, let me get all my boxes. Right. So, today we're going to be talking a lot about game theory. We'll do a quick look at markets, but remember, it's not really about what the exact prices of the markets are. It's more like the assets. So, don't get caught up in the price, especially if which you should be dollar cost averaging, but don't get caught up in trying to game the markets because you'll just get that pitifully wrong. I don't typically, especially when I'm buying assets, I'm dollar cost averaging. So again, for everybody that's not dollar cost averaging or you think you are, you need to make sure you actually are. And dollar cost averaging, it's a term I mention from time to time. Essentially, it means spreading your investment over a long period of time and investing on intervals, ideally randomized intervals. So what I do is I take whatever amount of currency units I have that I'm going to put into any market, any kind of investment. And I say, okay, whatever I have in May left over, some portion of that's going to go into the market in June. Whatever I have left over at the end of June, here in the next few days, I'm going to take that number. That's going to be my investable capital for July. I take that, whatever that number is, let's say it's $1,000. I'm going to break it into these kind of random intervals. What I like to do is go about every 5 or 6 days, and that gets me a different day each week, right? So I like 5 days, whatever. But if you were doing, let's say you were doing every 6 days, which would be 5 investments throughout that month, depending on which day you start, it would be $200 per investment, right? 5 investments of $200. There's your $1,000 that you had to invest. That's dollar cost averaging. It's not any more difficult than that. It is only that. But it's important that you maintain some kind of consistency in your dollar cost averaging. Okay, that takes the emotion out of it. So when you're looking at markets and you're looking at assets, I don't really care what the day-to-day price is of the assets that I'm looking at, as long as there is meat left on the bone. That's key. And so you say, what is meat left on the what? So when I go through my 5 T's to determine if I want an asset, because again, I think it could have the chance to reach use, utility, and wide-scale adoption. As I do my 5 T's, I'm looking at the team, the timing, the technology, the tokenomics. And you can apply this to traditional assets as well. You would just swap out tokenomics for fundamental economics. Like you would look into the distribution of equity. You would look into who holds what, insider behavior, things like that. So a lot of this information you can't get in the traditional space as far as looking at equities. You're only getting what they're telling you. And as you know, like every so often, what they're telling you is a big fat lie. That's frustrating. So why I like the digital asset space is you get a more accurate sounding on these things because it's not a bunch of people lying to you. You can look, you can read about the team. What have they done? What have they not done? You can look at the timing. Does it make sense right now? You can look at the technology. Is this a valuable technology, or is it, I don't like to use over and over the example of XRP, but it's a pretty good one here. The idea of XRP made a lot of sense 4 or 5 years ago, even 3 years ago. But you don't need a bridge asset anymore. And for those of you that are like, no, you need it, great reset. Well, if you need it, how come the company itself is not using it? Ripple, since they've been involved in this lawsuit with the SEC, they have not been using XRP because they don't know the status of the token yet until there's some kind of ruling, and then they appeal it, and everybody appeals, and everybody. So the company that has this big bag of tokens that's gonna perpetuate the Great Reset, if you believe that, doesn't even use the token that they're going to reset the earth to use. Doesn't make too much sense to me. So, and what's the problem? Well, the problem is the technology is not interesting, and there's not a lot of utility in the technology anymore. Now, they have some other technology at the company, but when you're buying XRP, you're not buying Ripple equity. You can buy Ripple equity. It's a separate thing. I get offers all the time from these second market companies that they're flipping Ripple equity. You can buy Ripple equity, but that's not what XRP is. So like a little bit of common sense, and as you're digging through this, you go, okay, the team. Well, two of the people are embroiled in a huge lawsuit. They definitely did some things that are borderline illegal and got caught. The question is, are they illegal or just immoral? They're definitely immoral. They might be both. You don't know. So the team, but then you got David Schwartz. David Schwartz is great, but David Schwartz is one among many creeps. So team's not looking good. And also, David Schwartz hasn't done anything else. They haven't done anything else over there. So I don't know, man. The XRP ledger might be cool, but XRP itself, if you're, again, just 5T'ing it, doesn't mean the price won't go up. I'm sure after this lawsuit is settled, XRP is going to get a huge relief rally. And then the reality will set in like, wait a minute. Okay, the team is still sketchy. They're just richer. They care less. The timing, 4 to 5 years late. The technology, not very interesting. Any token on Earth now, any layer one can do swaps. What do you think DeFi is? DeFi relegated everything that Ripple is doing just to the sidelines. Everything they do is just a feature of almost every layer one. It's just not that interesting anymore. I own XRP. I made a lot of money off XRP. I'm not a hater, but you have to put your currency units where they're going to do you the most good, where they have the most multiples. And whatever the great reset looks like, it's not likely to be sitting on top of XRP running through the ledger. And even if it is running through the XRPL, which is very unlikely, it doesn't need the token. You don't need, like people all around the world trading USDT, which is another scammy coin. They don't need XRP to do it. You don't even need XRP to do it on the XRP ledger. God. So technology failed. Tokenomics, huge fail. Had 100 billion. Jeb took a bunch, sold as many as he could get. Brad Garlic Mouth and Chris Grand Larceny, they each took billions themselves. Sold at discounts underneath the market, lied about it, got caught. Now they're in court. So does any part of this feel comfortable to you? No. And then why does the token exist? Well, I would have said to facilitate transactions on the XRP ledger, but it's not needed. You don't need the token. So if you do the 5Ts on XRP, it fails horribly. So again, I score these each by about 5 points. And if I get 18 to 20, then it's an asset that I might buy. Then I'm going to dig in a little bit deeper. And I'm going to say, okay, do they have a cash runway? Well, in Ripple's case, yes, they do. They can sell XRP. They get $1 billion a month unloaded from this escrow that they set up to evade arrest. And they get a lot of tokens. And so $1 billion, right? And $1 billion at 48. So they can sell tokens on a regular basis. And they can fund their business operations, which again looks a lot like a security. Anyway, the value, why do they exist? Well, they do, to transfer currency units back and forth in exotic corridors. I guess you could say, okay, there's a value there, like the value proposition. The direction, the management team, pretty poor, just pretty poor. If you join the Navy, they say the first thing you learn is, I will not lie, cheat, nor steal, nor tolerate anyone among us who do. They fail on that all over the place. I always contended that Ripple, the company, would be in a much better position if they had not fired, but parted ways with Brad Garlinghouse and Chris Grand Larceny right when the indictments happened. Matter of fact, if those guys gave a crap about anyone in the community, the people that made them rich, they would have fallen on their swords. They already made their money. They're already, centimillionaires or borderline billionaires off of you if you bought their tokens. They made that money off of you, and they're laughing. Like, they just laugh because they're already rich. There's nothing you can do to them. The fines are going to be paid by Ripple, not Brad and Chris. So it's so stupid. Anyway, management team, poor. Price. Is it priced? Is it valued or undervalued? Well, in the near term, I think it's probably undervalued as a trade. In the long term, I think it's extremely overvalued. I don't think the price of XRP should be above a few pennies, because if it's smooth and elegant for doing cross-border transfers and a bridge asset, which again, you don't need, but even if you did need it, if the transactions cost basically nothing, and unless you were transacting the entire pile of XRP every few minutes, there's plenty of XRP to provide worldwide liquidity. Remember, it goes down to 6 decimals. So you still have to multiply it by 10 to the 6th. It's like, come on, man. It's like when people talk about, oh, there's only 21 million Bitcoin. Yeah, there's only 21 million Bitcoin times 100 million because Satoshis. So it's 2.1 quadrillion Bitcoin. Well, that doesn't sound so rare. Doesn't it's a lot less rare when you say 2.1 quadrillion. No, it's not. It's 21 million. Okay, got it. All right, fair play. And then liquidity. Can I enter or exit the position? Well, you could have done that. You could have done that before it got booted off of a bunch of exchanges. So right now, the liquidity situation is not great. My guess is on the other side of this lawsuit, XRP is back on exchanges because, well, I'm assuming they'll say it's not a security, but that I don't know. It's clear that it was sold as a security. It's not clear at this point. I don't think it's a security. I don't think anything, even if it's sold as a security, like Ethereum was clearly sold as a security. But at this point, it's become this kind of commodity asset. It's a very good argument for commodity. So you can make that same argument for XRP. So we'll call it a commodity because it facilitates a 2-asset swap, right? Asset A to asset B, for instance, US dollars to renminbi, or euro to British pound, or something like that. So it again, it's not talking about whether it's necessary, not just the liquidity. So entering and exit. So there should be sufficient liquidity. There's tons of tokens, tons. Even if you count the ones that are locked up in escrow, there's still nearly 50 billion tokens floating out there. But they need to get back on exchanges. So liquidity right now, poor. But after this decision, my guess is some exchanges will relist the token and you'll get some liquidity back. Doesn't mean the price is going to go up, but at least you'll have some exit liquidity if you had to bounce. And then, is there any meat left on the bone? Well, near term, yes. Long term, I don't think so. But it doesn't matter what I think. You've got to go through and do this, make this kind of proposition to yourself. And what does meat left on the bone mean? Well, are there any multiples here to be made? Again, near term, maybe it sees a buck. I don't know why it would. At some point, the religious zealot community is going to grab a napkin and do some math and go, oh crap, like this coin doesn't have to be a buck. It will function just fine right now off of like 4 cents. So at some point people will do that math, and I think that they would determine that there's not meat left on the bone. We'll see. But anyway, so all of that is before you purchase one single token. Then you have to create some portfolio balance. So just keep in mind that there's a lot of steps. There's a lot of steps to this. But this is your fundamental framework. Now, what sits beneath this framework is game theory. And so today, I'm going to go quickly through our AI news. It's pretty interesting stuff. And then we will get to, I need to get a little thing that's like AI news, but I don't have that. I don't have that yet. So there we go. So too bad. So let's do this. Let's talk a little bit about AI news. And again, what was our market discussion? Nothing specific. Because nothing specific is really going on that you should be alerted to. It's more of the same. Bitcoin 30,000-ish. What's going on? Anything exciting? Near's caught a little bit of a bump. And by the time you see this, it's going to be a little bit old. because I'm recording this so that on my travel, as I go to the airport, it doesn't get all screwed up. But anyway, I just saw that Near was kind of bumped up a little bit, which that's usually sentiment based. There's no good reason for that company to be. I mean, cool tech, bro. It's up almost 30% in a week, but it's not decidedly interesting. There's nothing really else going on. That we're 1.2 trillion market cap. Great. That's it. Okay, let's talk for a second. Let's talk AI. Let me get like a cool picturey, graphy. I guess that's okay. That's hypercycle. I mean, hypercycle is AI. Oh, you know what we'll do? Here's what we'll do. I will say, we're gonna do an experiment. Let's go AI pictures. Then we'll go to images, and then we'll just pick a cool. Ooh, look at that brain. Ooh, good brain. Look at that brain. Okay, so that's gonna be our thing. Brain. All right. What's going on in AI news? Well, let's talk about the double-edged sword of AI's future. Experts are anticipating significant advances in healthcare, education, and scientific discovery due to the spread of AI. Like you catch it, honey. I wasn't at no strip club. I caught AI by sitting on a Denny's toilet seat. That's how I caught it. You caught AI, the horrible scourge. Anyway. They believe healthcare, education, scientific discovery will due to the spread of AI by 2035, while also voicing deep concerns. Deep. This is experts, by the way. Experts in the thing that's not here yet. Right. Deep concerns about potential societal issues, including misinformation, agree, surveillance, they're already doing it, wealth disparity, already got it, and the weaponization of social media. Yeah, no S. Hey, how about all those people getting fired? Come on, experts. You guys got to step up. The game is weak. All right, let's talk Harvard's AI intervention in education. Harvard, do tell. Harvard University is integrating its own AI, kind of a generative AI similar to ChatGPT, into its popular CS50 course to facilitate a simulated one-to-one teacher-student ratio. And this fosters individual learning styles. Why I think this is going to be really cool is because universities are going to have a huge shift that they're going to have to look at. The idea that people don't need universities anymore is, there could be some pretty good, compelling arguments made for this. And if these universities go straight into the home, straight into the computer or the eyeball of their prospective students, like I know a buddy who just completed 2 master's degrees at Harvard from Texas. Like masters. He has a master's, 2 masters from Harvard, did it at home. He just flew out there to graduate, gets a little stupid flippy cap or whatever. Anyway, kind of interesting. So universities are going to have to go through a pretty substantial paradigm shift if they want to exist. I think, God, it'd be weird, but maybe the University of Phoenix had it right all along. All right. Okay. You know what? It makes my cheesy online degree, my doctorate in the philosophy of religion from the Universal Life Church. It makes that seem a lot less bogus, but it's still bogus. Although, because it's a religious organization, I can put it on my driver's license. Dr. Nick Black. Religious, whatever. I don't know. Someone's like, I'm dying. Can you help me? I'm like, not that kind of doctor, but I can talk to the ferryman as you cross over. Maybe do some negotiating with the Grim Reaper. Anyway, let's talk understanding business adoption of generative AI. As generative AI gains popularity, businesses of all sizes are keen to leverage its potential, yet face challenges like high costs, the need for specific expertise. Successful adoption involves understanding AI's limitations and strengths, the importance of domain expertise, and practical considerations for investment decisions. Yeah, so let me boil down to you business adoption of generative AI and AI in general as we endeavor, hopefully in a benevolent and kind and beneficial way, towards the kind of triple H AGI that we hope for. Helpful, harmless, honest, maybe even hopeful. Hopeful is probably us on the sidelines. But The reality is businesses are going to be replacing people with software. But the first phase shift, I think, is going to be people leveraging AI software. And then the people that are not, they go away. Already in the age cohort of over 50, only 1 in 4 over the age of 50 are even have even messed with ChatGPT. If you can hear my voice and you have not played with ChatGPT, you don't have it on your phone, you haven't even messed with it, you haven't done searches with it, then you are probably already a dinosaur. You can say whatever you want right now. You can backwards regress your thinking. You can, you can curl up. Oh, he doesn't know. Yeah. Well, numbers don't lie, dummy. So if you are over the age of 50 and you can hear me and you have not played with, messed with, studied, at least spent 15 minutes messing with a generative pre-trained transformer network, a large language model, AI, you're a dinosaur. You're either already fired and you don't know it, or you're about to be fired and you do know it. So there you go. And the numbers are not much better until you get into like the 18 to 35. And then everybody's like, yep, this is the way things work. Just change. Just change. Stop what you're doing right now and just change. It doesn't matter if it's uncomfortable. Everything's uncomfortable until you do it. Right? On vacation, I'm going around like we went snorkeling. People are like, I've never snorkeled. Okay, well, learn how to snorkel. It takes 5 minutes. Now they're snorkeling, having fun, seeing fish and crap. Woo, the world's so great now. I'm floating. I'm like an astronaut. Yeah, 5 minutes ago you were scared. Now look at you. You're having fun. So just change. It's so freaking simple. Anyway, all right, cool. Let's switch gears. We need to talk game theory, and we are going to talk about a very different kind of dilemma today. We're going to talk about the real estate dilemma, and there's kind of two dilemmas. So as we approach this, we are going to talk about, I guess I should get a picture of a house, right? Okay, so let's find a picture of a house. Screw it. You guys get it. I'll do you one better. I'm going to throw up a payoff matrix. Bam! For those of you that can see it, let me see if I can push this over just a hair. Okay. This is the commercial real estate dilemma. We have two dilemmas in game theory for today. And one of them is the commercial real estate dilemma. Whether to keep paying for a commercial property or to declare bankruptcy and walk away from it. The other is the homeowners, kind of a similar homeowner dilemma, right? And so, there's a lot that goes into this. There's a lot you need to think about. I'm going to break it down for you real simple like. But it is important to kind of think about these things. They're not so kind of black and white. At first, you may think, oh, this is very easy. I would never. I should. Well, there's times where you would and should do all sorts of things to protect you, your livelihood, your family, your portfolio, things like that. So again, let's talk about bankruptcy or not in the real estate context. So I'm going to give you a simple game theory example to explain whether a company should keep paying for a commercial real estate property or declare bankruptcy. Now, what you see in front of you is the payoff matrix for this scenario, but I want you to kind of relax for a second and just absorb. So imagine there's a company, and we'll call them Super Snacks. If there is a Super Snacks out there, this is not them because I don't know anybody at Super Snacks. But anyway, Super Snacks, woo! They sell, delicious snacks, obviously. They have a store at a very prime location. They need to decide whether to keep paying for the commercial real estate property or declare bankruptcy. As you know, the world's going into recession. Why is this apropos? Man, if you saw, look, the numbers came out last Friday were not so great, PMIs. So this is commercial real estate is about to go through a big battle, a battle of solvency, a battle of liquidity, and there's going to be a lot of banks, small and regional and mid-sized banks, on the hook for a lot of a lot of debt. This could get pretty gross. Anyway, so this is an apropos kind of example. Anyway, so they have this prime location, Super Snacks. They got to decide, do we keep paying the commercial real estate property, or do we declare bankruptcy and walk away from this thing? Super Snacks faces two options. Option A, continue paying for the property and keep the store open. Option B, declare bankruptcy and close the store. Okay. Now, I know there's a lot of factors, right? But let's imagine we're in a scenario kind of like now, right? Where the world's going into recession. There's a global cooling, a global tightening. Things aren't working so well. And good news, all of the central bank and fake central bank officials, like at the Fed, don't understand what's going on, and they're doing the exact wrong thing to solve it. So assume you're getting no help from central banks and economists and monetary policy decision makers. So to make the decision, Super Snacks needs to consider the actions of their competition. We will call them Yummy Treats. Now, Yummy Treats is pretty smart. Yummy Treats saw this coming. They saw this coming a long time ago. Anyway, they sell pretty good snacks. They're not super delicious, but they're pretty delicious. They're yummy, hence the name Yummy Treats. So they have a store nearby. If Super Snacks decides to keep paying for the property, they're going to hope that customers will choose their store over Yummy Treats because of this prime location, but they're paying a premium for that. If Yummy Treats sees that Super Snacks is struggling and might close, they might lower their prices and offer more discounts to pull more of the people away from Super Snacks to ensure their demise. And then once they're gone, they could bring their prices back up. On the other hand, if Super Snacks, I prefer Super Snacks, I think they're more delicious, decides to declare bankruptcy and close the store, Yummy Treats will be the only snack store in that area. And now Basic will be premium because all there is Basic, right? Was it in the land of the blind, the Cyclops is king? So this could lead to an increase in customers for Yummy Treats since they no longer have any direct competition with Super Snacks. Super Snacks closed down. So the game theory here is about understanding the possible actions and reactions of Super Snacks and Yummy Treats. Now, yes, we have the backdrop of a global depression, all this kind of stuff. But even if you reduce all that, even if you forget about that, you can just look at the strict competition and say, man, if Super Snacks gets beat up a little bit in the markets, if some macro factors don't go their way, they got to decide, they have to consider, how will their decision affect Yummy Treats? How will Yummy Treats respond? And it becomes this strategic game where each company tries to outsmart the other to attract more customers. Ultimately, Super Snacks should analyze factors like their financial situation, global market conditions, the potential response from Yummy Treats to make the best decision. They need to consider whether there are advantages of keeping that prime location and whether that outweighs the risk of the increased competition from Yummy Treats, whether they can run that prime location as a loss leader. You see this a lot in Los Angeles. You see companies open up storefronts that are losing money. They're but they have to maintain the presence. They have to maintain the look, right? That cachet. So there's a lot of things to factor in. Part of that could be a loss leader, but you apply it to marketing. Anyway, when you look at the game theory involved in this, when you apply game theory, Super Snacks can evacuate their prime location, or they can stay. Yummy Treats may or may not be a beneficiary, but the team at Super Snacks, they can look at all of these possible outcomes and make a decision that maximizes their chances of success or at least minimizes their loss. So if we break it down, let's consider the payoff matrix, which is what you're looking at, and analyze the situation between Super Snacks and Yummy Treats. So in this matrix, this is called a payoff matrix. And I didn't plus or minus this one. I'm trying to keep this one a little bit simpler and just keep it more theoretical. But you could ascribe points to this. So we'll consider the payoffs or outcomes for Super Snacks and Yummy Treats based on their decisions. So let's assume there are two possible strategies for each company. Super Snacks can either keep paying for property or they can declare bankruptcy, while Yummy Treats can either maintain their current strategy or lower their prices. So even though Yummy is like a second tier venue, they've been a little bit smarter. They have a little bit more leverage. Yummy's not looking at going out of business. Yummy's looking at maintain the current strategy or lower prices to vampire away clients and ensure fatality, ensure the death of super snacks so they can be the last one standing. Does that make sense? So this payoff matrix, you can see it's in two columns. You have Yummy Treats maintaining their current strategy or lowering prices. And then on the left-hand side, you have super snacks, and they can either keep paying or they can declare bankruptcy. And this payoff matrix, in the matrix, each cell represents the outcomes for both super snacks and Yummy Treats based on their respective decisions. A lot of times, these payoff matrix will just have +1, -5, +3, whatever. Just reduce it to points. But in this example, I want you guys to reduce it to theory. So we'll focus a little bit more on theory and less on a point structure. You can ascribe points to any of this, but this is based on each one's decisions. The payoffs are subjective, and they can be assigned numeric values based on each specific situation. Again, let's consider them as high profits, moderate profits, low profits, or no profits. So here's how we interpret the matrix. If Super Snacks decides to keep paying for property and Yummy Treats chooses to maintain their current strategy, Super Snacks may enjoy higher profits while Yummy Treats could have moderate profits. This is kind of a status quo. The thing is that in Super Snacks situation, they may need high profits just to break even, right? Because they're paying a bunch on rents. They're paying really high rent. So next scenario, if Super Snacks keeps paying for the rent at this prime location, but Yummy Treats lowers their prices, then Super Snacks may have moderate profits, but Yummy Treats might also reduce their profits to a lower level. So Yummy Treats may end up losing out trying to go to war, right? But they may also lower prices and force Super Snacks to a situation where they might have to declare bankruptcy. So then you say, okay, well, crap. If Yummy Treats lowers prices and Super Snacks takes that big of a hit, then Super Snacks is going to have to declare bankruptcy regardless of Yummy Treats' strategy after that point, because there's a point where Super Snacks will say, that's it. Like, we're busted. We're broken. So that point where Super Snacks may declare bankruptcy, Yummy Treats' strategy is no longer important. Once they say that's it, pull the plug on grandma, then that's it. Super Snacks won't make any profits. And Yummy Treats, for a small amount of time, might make no profits. But at that point, they can kind of do whatever they want. So the payoff matrix helps both of these companies evaluate their potential outcomes of these decisions and the possible response from their competitors. And they do this by considering the payoffs associated with each strategy or combination. Again, you could ascribe points to this, but this is, again, go through the theory in your mind of if A does this and B does this, assuming that A will do that, and A does this, assuming that B will do that, because they assume they're each rational players looking to maximize their payoffs. Payoff maximization. Does that make sense? Okay. So by considering the payoffs associated with each of these strategies, Super Snacks can assess the best course of action to take to either maximize their profits or minimize their losses. It becomes one or the other. Either make as much as we can, pay this high rent, or let's deuce out and lose as little as possible. And it allows them to think strategically and make a more informed decision based on the expected outcome of this scenario. So it becomes a competitive scenario, even if you don't think it does. So this was the commercial real estate scenario. I have another scenario, which is a homeowner scenario, but I'm going to do that on a different day because I don't want to mix thought processes. So I want you to go over this in your mind. Many of you may have owned businesses, may currently own businesses, or be part of a large structure, maybe a franchise system, whatever. And you realize that this is probably going on behind the scenes all the time. You probably ask yourself, why do they keep that location open? It's always a dog. New managers go in, nothing changes. It's like, God, some demographics do matter, as it turns out. So There's a lot going on behind the scenes, but you just have to make the best decision. Even if it's a choice of two bad decisions, there's a bad decision and a worse decision. So, in game theory, you may have to make hard choices, but at least if you start breaking it down this way, then you can make a best bad decision. And sometimes the best bad decision is a pretty dang good decision. So with that, take some time, enjoy your Tuesday, stay in school, don't do drugs, don't do anything my poor insolvent drunk struggling on meth grandmother wouldn't do. Make good decisions. Think about game theory. Even if you're not, you probably are. You might as well have a formalized system, a framework for making these decisions rather than whimsy. Because if you do create this kind of formalized system of game theoretical thinking, no one else is doing this. So you're going to be ahead of the ball, like way ahead of the 8 ball. And remember, when the bear comes to the campfire, you don't have to outrun the bear. You just have to outrun the fat kid. And if you think about things theoretically, game theoretically, guess what? All of your peers pretty much become fat kids. And then it's very easy to escape. So when the bear comes, you just tie your shoes. Don't worry. Fatty McGillicuddy over there is going to twist an ankle and be the first thing that they fillet. All right. We will see you tomorrow for Digital Heavyweights on Wednesday. Same bat time, same bat channel.